Today, we're counting down the 9 things you need to know about value investing. If you're buying stocks with low price to earnings ratios and low price to book ratios, that does not by default mean that you're making a value investment. Nope. The truth is that a company which many financial websites would categorize as a growth stock can absolutely be a value investment, as long as its price is lower than its intrinsic value. Intrinsic value is the major key alert in value investing. Value investing just means buying stocks for less than they're worth. More on this coming up. Unfortunately, a lot of financial websites will put stocks into a category of value or growth based on its price to earnings ratio and price to book ratio. And that's just seriously unfortunate because it causes confusion for new and aspiring investors. And it's probably what has caused some people to even say value investing is dead. Value investing could never be dead, right? Because how could buying something for less than it's worth ever become a bad investment strategy? Here's number 8, but first, please hit subscribe and comment below saying I subscribed, and I will personally respond to every one of those comments. Okay, number 8. Value investors understand the magic of compounding. Albert Einstein said that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Think about a snowball. When you start rolling it, it starts off small at first, but as you continue to roll it, not only does it get bigger, but the rate at which it grows increases. The bigger it gets, the faster it grows. The snowball is compounding, it has exponential growth, and your money can compound too. And tapping into this is the clearest path to wealth. Look at this table, and you can pause this video here if you want because I'm not gonna stay on it long. But if you compounded your money at 5% per year, after 40 years, $10,000 will have turned into $70,000. If you can compound your money at 10% per year, well, after 40 years, $10,000 will have turned into $450,000. Look at how much money you would make if you could compound your money at 20% or 30%. Value investors do not guess what the market will do. They don't need to be checking their phones constantly, and you don't need to see them with a bunch of monitors with all these charts on them. If anything, value investors do their best to ignore all this noise. Those people with all those monitors and their charts, they're what's called day traders or swing traders, and they're trying to make an income based on small price fluctuations. By the way, just stay away from trading. It's just gonna take your money away from you and waste your time. In the future, you'll think, wow, I wish I just started value investing from the beginning instead of wasting my time with this trading. Traders, they need an entirely different skill set than investors. That is, traders need to be good at predicting what other people are gonna do. And it's not even just that, but they actually need to be good at predicting what other people are predicting what other people are gonna do, and so on, depending on how deep you wanna go. Trading is a lot more like playing poker, if anything. Investing is an entirely different game altogether. So, value investors, they don't care what other people are doing, and they don't try to predict it either. There's a business behind every stock, and if that business does well, then the stock will do well too. When you own shares, you own a percentage of a business. It's no different than if you owned a family business with your parents and your siblings. Maybe it's been divided up into 6 equal parts and you own 1/6 of this family business. If you bought your sister's share, well, now you'd own 2/6 of that business, and you would be entitled to 2/6 of the results of that business. Stocks work the same way, but instead of a company being divided up into 6 equal shares, well, sometimes they're divided up into millions or billions of shares, and those shares can be bought and sold very easily through the stock market. So, value investors realize that owning shares means owning a piece of a business. Benjamin Graham is the godfather of value investing. He wrote what's considered the Bible of value investing, The Intelligent Investor, right here. And he was also Warren Buffett's teacher. Benjamin Graham's teachings were heavily focused on buying stocks that were trading below what they could be liquidated for. And this is what Warren Buffett is talking about when he refers to buying dollar bills for 50 cents. Ben Graham, he called them net nets, and Warren Buffett, he called them cigar butt stocks. Buffett started his career looking for and buying these types of cigar butt stocks, but eventually when he met Charlie Munger, he changed his approach from buying fair businesses at wonderful prices, Ben Graham style, to buying wonderful businesses at fair prices, Charlie Munger style. By the way, this book right here, although it is very good, it's not exactly beginner friendly, and if you're not used to reading, it's gonna put you to sleep. So I would actually suggest this book instead. This one is definitely gonna make you a better investor. This is called The Outsiders by William Thorndike. A stock's per share price has very little meaning. Market cap is what's important. Here's an easy way to tell the difference between someone who knows what they're talking about with stock investing and someone who doesn't. Amateurs talk about per share price. Pros talk about market cap. A good way to think about the market cap is you can think about it as the price tag on the entire company. What the market cap is it's the valuation that everyone collectively is putting on a company. Market cap will usually show alongside the price per share somewhere in most places that you look, whether that's on Google or in your app. And the market cap is calculated by taking that price per share and multiplying it by the number of shares outstanding. And shares outstanding, well, that's how many shares the company's ownership has been divided up into. So the bottom line is that value investors think in terms of what the entire company is worth. Market cap does not equal intrinsic value. Stock prices are determined by the market as a collective. The current price at any given time is just whatever the last transaction was for. The efficient market theory, would say that the price is always perfectly efficient and that the collective is always accurate. But value investors know better. Value investors know that just because the market as a collective has put a particular price on a stock does not mean that that represents its true intrinsic value. Intrinsic value is something you need to calculate for yourself, and then you can compare it to the price. Many value investors, Warren Buffett included, prefer to first and foremost determine what they think the intrinsic value is before they even look at the price to see what it's trading for. And their reason for not looking at the price until the very end is to avoid any chance of being influenced by that collective market. So, value investors are independent thinkers. The intrinsic value of a company is equal to the total of all the cash it can generate for you in its lifetime, discounted back to its present value. Let me explain. If a company were to generate exactly $1 million of cash every year, so I'm talking profit, that's money you could put in your pocket. So every year, 1 million for 10 years. And then after that 10 years, that company would just cease to exist. That company would be worth $10 million. However, there's a problem with this. $1 million earned 10 years from now is not the same as earning $1 million right now. Just inflation on its own would make that $1 million earned 10 years from now have much less purchasing power than $1 million earned right now would have today. So what you need to do is you need to discount that $1 million earned in the future 10 years from now, discount it back to its present value today. If we were using a discount rate of 2%, the numbers would look like this. $1 million earned 10 years from now has a present value of $820,000 using a 2% discount rate. $1 million earned 9 years from now has a present value of $836,000 using a 2% discount rate, and so on and so on. When we add up the present value of all that future cash, we get to know the present value of this business based on a 2% discount rate, which is $8.9 million. If you want to see exactly how to calculate intrinsic value using a real-life example of Apple stock, then go ahead and click on this video right up here. I'm warning you though, it's a beast of a video, so just be ready. So value investors, they calculate intrinsic value, and one of the best ways to do that is by calculating the present value of future cash. That's how Warren Buffett does it. Productive versus non-productive assets. Maybe you saw the headlines earlier this year, Buffett buys gold, what's going on? And the reason why this was such a shocking headline to investors was because Warren Buffett has always been very anti-gold. Buffett did not buy gold, by the way. He bought a gold mining company. Very different. A business is a productive asset, so a gold mining company is a productive asset. Gold itself, on the other hand, is just a chunk of metal. It doesn't produce anything. A business produces a product or a service which is sold, and at the end of the day that means earning cash for the company, and you can figure out what they're worth by estimating that future earnings. On the other hand, gold or cryptocurrency like Bitcoin or collector's art or Pokemon cards, these are all in the same category, non-productive assets. They don't produce anything, they just sit there. You can trade them and hope that somebody else will buy them off of you for more than you paid, but that's it. So you cannot invest in gold, you can only trade it. But here's the main problem with buying non-productive assets. It's that the money can't compound. And compounding your money is the secret to wealth. So, value investors deal in productive assets and they stay away from non-productive assets. Hey, please go and share this video right now. And also remember, I'm not a financial advisor, just a guy on YouTube. So seek advice from a qualified professional before you make any investment decisions. And if you want to keep learning, I got this next video for you right here that's gonna blow your mind.